What if the investment you were told could secure your retirement was actually designed from the beginning to take it? A retired teacher stares at her laptop screen as the numbers collapse. $187,000, $96,000, $14,000, then almost nothing. Across the world, thousands of investors are watching the same thing happen in real time. Retirement accounts vanish. College funds evaporate. Entire life savings disappear in less than 72 hours. No warning, no insurance, no one to call. Meanwhile, on social media, celebrities are still posting smiling advertisements for the very assets that are now destroying people's financial lives. This is not a market correction. This is not normal volatility. This is the moment when one of the most sophisticated financial experiments in modern history reveals its true nature. Because behind the promises of decentralization, behind the futuristic language about blockchain technology, and behind the viral success stories of overnight millionaires, something far more disturbing has been quietly unfolding. Between 2009 and 2024, cryptocurrency exploded into a global industry worth more than $2.5 trillion at its peak. At the same time, the FBI reported more than $15 billion lost to crypto-related fraud in 2022 alone. And the people losing that money were not hedge fund managers or Silicon Valley venture capitalists. They were teachers, retirees, small business owners, ordinary people who believed they were investing. And what we found at the center of this story will change the way you think about cryptocurrency forever. In this investigation, we are going to examine a question that many financial experts have been quietly asking for years. Is cryptocurrency actually an investment, or is it one of the most brilliantly engineered financial crime ecosystems ever created? This video will walk you through the rise of crypto from its mysterious birth in 2009 to the catastrophic collapses that have wiped out tens of billions of dollars in ordinary investor savings. You will see exactly how the system works, how billions were funneled through unregulated exchanges, how celebrities and influencers promoted assets they often didn't even understand, and how some of the most powerful figures in the industry built reputations as financial geniuses, while secretly operating systems that collapsed the moment confidence disappeared. But this story is not just about the fall of Terra Luna. It is not just about the collapse of FTX. And it is not just about one dishonest billionaire. By the end of this video, you will understand something that most investors never realize until it's too late. The structural weakness at the core of the crypto market, a weakness that could determine the future of your savings, your retirement, and your financial security. Stay with me until the end, because the final lesson in this investigation could be the most important thing you hear all year. Before we go any further, if no one in your life is warning you about the financial dangers hiding inside the cryptocurrency industry, then this channel exists for you. Every week, we expose the financial crimes that powerful people hope you never find out about. Hit subscribe and the bell icon right now, because the investigation we are releasing next week could directly affect your savings, retirement, and investments. Do not let your guard down. The story begins with a ghost. In 2009, a mysterious figure using the name Satoshi Nakamoto releases a piece of software called Bitcoin. No photograph, no verified identity, no physical headquarters. Yet the idea spreads like wildfire. Bitcoin is presented as revolutionary, a form of money that operates without banks, governments, or central authorities. A financial system controlled entirely by code and mathematics. Early adopters describe it as the future of finance. Silicon Valley investors praise its innovation. Tech enthusiasts celebrate its promise of freedom from traditional banking systems. To the outside world, it looks like a technological breakthrough. But few people stop to ask a simple question: what exactly gives this digital asset its value? The timing could not have been more perfect. Just 1 year earlier, in 2008, the world experienced the worst financial crisis since the Great Depression. Banks collapsed. Stock markets crashed. Millions of families lost their homes. Public trust in traditional financial institutions is shattered. For many people, especially those who watch their retirement funds shrink overnight, the idea of a new financial system outside the control of banks sounds appealing. By 2017, cryptocurrency markets are exploding. Bitcoin surges past $19,000 for the first time. Hundreds of new digital coins appear almost overnight, and millions of ordinary investors begin asking the same question. Are they missing the opportunity of a lifetime? One of them is David Mitchell, a 56-year-old electrician from Ohio. David has spent 3 decades working long days installing electrical systems in office buildings and hospitals. His retirement fund sits at $412,000. He hopes to retire at 65, travel with his wife, and help his daughter pay for graduate school. Then one evening in 2021, a colleague tells him about cryptocurrency. Within months, David moves $210,000 of his retirement savings into crypto investments promoted online. The profits look incredible at first, but one small warning sign appears early, a detail that will later prove devastating. No one regulating the market. To understand how this system operates, you have to understand one simple mechanism. Cryptocurrency prices rise almost entirely because new buyers enter the market. Unlike stocks, which represent ownership in companies generating real revenue, or real estate, which produces rental income, most cryptocurrencies generate no cash flow and are not backed by physical assets. Their value exists primarily because someone believes another person will pay more later. In finance, this dynamic is often called a greater fool theory. It means an asset rises not because it produces value, but because someone believes a greater fool will buy it at a higher price. Now watch what happens next. 2013, the first major crypto boom begins. Bitcoin rises from $13 to $1,100 in less than a year. New online exchanges appear where people can trade digital coin for dollars. One of them, Mt. processes nearly 70% of all Bitcoin transactions worldwide. But in 2014, Mt. suddenly collapses. 850,000 Bitcoins vanish, worth about $450 million at the time. For investors, the money is gone. Yet instead of killing the industry, it makes it bigger. And the next phase becomes far more aggressive. 2017, the ICO explosion. ICO stands for Initial Coin Offering. Think of it as a crowdfunding campaign for new cryptocurrencies. Anyone can create a digital coin, write a vague description of its purpose, and sell it to investors online. In 2017 alone, ICO projects raised $5.6 billion from investors worldwide. Many of these projects have no product, no revenue model, and no functioning technology. At the same time, people like David Mitchell are watching crypto prices soar. His initial $210,000 investment grows to $640,000 on paper. Friends call him a genius. He considers retiring early. But behind the scenes, another development is unfolding. Crypto exchanges, the platforms where people store and trade their coins, are quietly becoming some of the least regulated financial institutions on Earth. And one of them is about to become the center of the largest crypto collapse in history. 2019, a young billionaire rises. A 27-year-old entrepreneur named Sam Bankman-Fried launches a crypto exchange called FTX. He appears brilliant. Media outlets describe him as a financial prodigy. By 2021, FTX is valued at $32 billion. Celebrities like Tom Brady and Larry David promote the platform in global advertising campaigns. Millions of investors deposit money. But the detail that will truly shock you is still to come. Because inside FTX, something extraordinary is happening. Customer deposits are secretly being transferred to a trading firm also owned by Bankman-Fried. That firm, Alameda Research, is using the money to make high-risk bets in the crypto market. At one point, more than $8 billion in customer funds is missing, yet almost no one notices. In fact, in 2022, Bankman-Fried is testifying in Washington about crypto regulation, presenting himself as the industry's responsible leader. Then the system reaches its peak. Crypto markets surge past $2.5 trillion in total value. David Mitchell's portfolio reaches $1.2 million. But beneath the surface, the foundation is already cracking. And when the collapse begins, it will spread faster than anyone imagines. Before I reveal what happened next, I want to pause and ask you something. Have you ever considered investing in cryptocurrency because you were afraid of missing out on what everyone else seemed to be getting rich from? Or have you already put money into crypto yourself? Drop your answer in the comments right now. I personally read every single response, and your experience might be more common than you think. But here's the part of the story that most people never find out. The biggest collapses in cryptocurrency were not accidents. They were structural. Take the case of Terra Luna. In May 2022, Terra Luna is one of the top 10 cryptocurrencies in the world, with a combined market value of more than $40 billion. Its creator promises something extraordinary: a stablecoin. A stablecoin is supposed to hold a steady value, usually $1, making it safe for investors who want stability. But Terra's stability is not backed by real dollars. It is backed by a complicated mathematical relationship with another token called Luna. When confidence is strong, the system works. When confidence breaks, the system collapses. In 72 hours, Terra Luna's value crashes from $40 billion to almost zero. Hundreds of thousands of investors lose everything. Now, combine that with what happens later that same year. When FTX collapses in November 2022, investigators discover that billions in customer deposits were never truly separated from company funds. In traditional finance, this would be illegal. Banks must keep customer deposits separate. Brokerage firms must follow strict auditing rules. Crypto exchanges? Many operated without those safeguards, which means the industry's most trusted platforms were often operating more like casinos and financial institutions. And the system that allowed this to happen, it is still operating today. The beginning of the end arrives quietly. In November 2022, a leaked balance sheet reveals that Alameda Research, the trading firm connected to FTX, holds billions of dollars in assets that are mostly composed of its own exchange token. That discovery triggers panic. Investors rush to withdraw their funds. Within 48 hours, customers request more than $6 billion in withdrawals from FTX. The exchange cannot pay them because the money is already gone. On November 11, 2022, FTX files for bankruptcy. Millions of customers around the world suddenly realize they may never recover their deposits. Authorities move quickly. In December 2022, Sam Bankman-Fried is arrested in the Bahamas at the request of U.S. prosecutors. He is extradited to the United States and charged with wire fraud, securities fraud, conspiracy, and money laundering. Prosecutors allege that he misused $8 billion in customer funds. During the trial in 2023, former executives testified that the system allowed Alameda Research to withdraw unlimited money from FTX accounts, money that belonged to customers. In November 2023, a federal jury finds Bankman-Fried guilty on 7 criminal counts. He faces decades in prison, but the legal outcome does not restore the losses. David Mitchell, the electrician who invested $210,000 of his retirement savings, watches his portfolio collapse during the market crash. At its peak, it was worth $1.2 million. After crashes of Terra Luna and FTX, it falls below $38,000. His retirement plans change overnight. Instead of retiring at 65, he continues working into his late 60s. Across the world, thousands of similar stories emerge. Teachers, nurses, small business owners. Many discover that the platforms they trusted were not covered by the investor protections that exist in stock markets or pension funds. Regulators begin tightening rules in some countries. Yet globally, the crypto market continues operating with vastly different levels of oversight. And that raises a difficult question. Has the system really changed, or is it simply waiting for the next collapse? Lesson 1. If there is no underlying value, it is not an investment. It is speculation. Stocks represent ownership in companies that generate revenue. Real estate produces rental income. Bonds are backed by governments that collect taxes. Most cryptocurrencies produce none of these things. Their value depends largely on the belief that someone else will buy them later at a higher price. What this means for you? Before investing in anything, ask a simple question. What real-world value creates this asset's price? If the answer is unclear or overly complicated, walk away. Lesson 2. When celebrities and influencers promote a financial product, your money is often the product. Throughout the crypto boom, celebrities promoted exchanges and coins to millions of followers. Some were paid millions of dollars for those endorsements. Their audiences invested because they trusted them. But those promoters were not risking their own savings. What this means for you: never make an investment decision because a celebrity or influencer recommends it. Always verify the information independently. Lesson 3. Unregulated markets attract financial criminals. Regulations exist to protect investors. They require audits, transparency, and strict rules about how companies handle customer money. Many cryptocurrency platforms operate outside those protections. What this means for you: before investing, check whether the platform is regulated by your country's financial authority, such as the SEC, FCA, ASIC, or IROC. If you want a complete guide to protecting yourself from crypto-related fraud, I have put together a free resource for you. The link is in the description below. So let's return to the question we started with. What if the investment you believe could secure your retirement was actually designed in a way that made massive losses almost inevitable? After examining the history of cryptocurrency, the explosive growth, the unregulated exchanges, the celebrity promotions, and the collapses that erased billions, one uncomfortable reality becomes clear. Many parts of the crypto ecosystem were built on speculation rather than real economic value. That does not mean every technology behind cryptocurrency is worthless, but it does mean the financial system built around it has repeatedly allowed ordinary investors to carry enormous risk, while a small number of insiders captured enormous rewards. And the people most affected were often those who could least afford the loss: retirees, workers nearing the end of their careers, families who believed they were investing in the future. The deeper lesson of this investigation is not simply about cryptocurrency. It is about vigilance. Because financial history shows the same pattern again and again. When markets become complicated, when profits seem effortless, and when powerful voices tell you there is nothing to worry about, that is often a moment when caution matters most. Because the most dangerous financial crime is not always the one hidden in darkness. Sometimes it is the one happening in plain sight. Thank you for watching this investigation. It means everything that you stayed until the end. If this video opened your eyes, please like it right now. It takes 1 second and helps more people find this information when they need it. Share this video with someone you care about. Subscribe to Financial Crimes Exposed so you never miss an investigation that could protect your financial future. And that reminds me, drop a comment below. Do you believe cryptocurrency is an investment or speculation? Your next investigation is already waiting for you.